What does a 1% drop in a major market really tell you? Today's move in Russian equities offers a clear lesson in how rates and inflation drive stock prices. The MOEX Russia Index fell 1.04% at the close. That pullback reflects a cautious tone as investors reprice risk. The backdrop is tight domestic policy, stubborn inflation pressures, and a global market still anchored to central bank signals, especially from the Fed. Here's what matters. Russia's policy rate was last known at 16%. That's high, and it shapes everything from corporate financing costs to equity valuations. When the hurdle rate is steep, future earnings are worth less today. That favors companies with strong cash flow now and modest leverage, while it challenges high-growth names that depend on cheap capital. Inflation is the second anchor. The central bank targets 4% in the medium term. If investors believe price pressures will stay sticky, they push out expectations for rate cuts. That keeps discount rates elevated and compresses price-to-earnings multiples. Equity markets feel that pressure most in domestically focused sectors, where financing and local demand hit margins and volumes directly. Global policy adds the third layer. The Fed's path influences the dollar, cross-asset volatility, and capital flows. A firm dollar and higher global yields can sap appetite for risk assets. Exporters may find some cushion if commodity prices hold and the currency backdrop supports revenue translation, but their earnings still depend on external demand and input costs. So what can investors do with this? Start by stress testing valuations against a sustained high-rate regime. Focus on balance sheet strength, free cash flow, and pricing power. Revisit sector mix. Domestically oriented names often carry greater multiple risk when rates dominate the narrative, while exporters hinge on global cycles and commodities. Mind currency exposure and liquidity. If you use ETFs for Russia-linked exposure, check index composition, dividend policies, and tracking costs. Be deliberate with entries. Scaling in can reduce timing risk when rate paths are uncertain. Watch 3 signals. Policy guidance from the central bank, especially any shift tied to the 4% inflation anchor. Monthly inflation prints that confirm or challenge the disinflation trend. And global rate expectations, since a pivot by major central banks can reprice risk quickly. A 1.04% slide is not a crisis, but it is a reminder. In high-rate environments, cash flow, quality, and discipline lead. Read the full article at finlitica.com.